Hello and welcome to Startup Street. I'm Shruti Mishra and these are the top headlines from the startup space. Process, the parent company of fintech major PayU, terminates the proposed acquisition of BillDesk for $4.7 billion, saying certain conditions were not fulfilled before the September 30th deadline. The deal would have been the second largest in India's internet economy and would have created the country's largest online payments entity. Enterprise-grade blockchain startup XDC Network receives $50 million from LDA Capital. The founders of the XDC Network have leveraged a portion of their personal token allocations to secure the capital to accelerate the expansion and development of Layer 2 projects across the ecosystem and to facilitate network adoption and real-world utility. Neo-banking platform Vance raises $5.8 million in a seed round led by Hummingbird Ventures. The round also saw participation from global founders Capital, Y Combinator, Soma Capital and others. Vance plans on going live in the UAE and UK by the end of 2022. Wow Momo Foods launches 3 of its outlets in the metaverse. The brands are on a new metaverse platform called Festive that curates festivals of India across the year. The brand aims to start trading from their metaverse stores. Consumers can trade on metaverse stores and convert NFTs and redeem it on physical outlets. Tencent is resetting its M&A strategy to put more focus on buying majority stakes mainly in overseas gaming companies as the tech giant eyes global expansion, Reuters reported. It is now aggressively seeking to own majority or even controlling stakes in overseas targets, notably in gaming assets in Europe. Google shuts down the Google Translate service in mainland China, citing low usage. The move marks the end of one of its last remaining products in the world's second largest economy. The dedicated mainland China website for Google Translate now redirects users to the Hong Kong version of the service. However, this is not accessible from mainland China. Well, those are the headlines we are tracking for you this evening. E-commerce players in India witnessed a growth in demand for this festive season, according to data from Unicommerce. Now, the sector has seen a 35% growth in sales for this festive season as compared to the same time last year. The highest contribution to the festive sales came from the personal care and electronics segments, accounting to over 60%. Shilpa Ranipeta joins in with the key takeaways from the festive sale. Shilpa, what are you picking up?
Well, e-commerce platforms have seen better than expected sales in the first leg of the festive sales, and over 60% of the orders came from tier 2 and 3 towns. Now, this is what data by Unicommerce had shown. Now, while the overall personal care and electronics led the growth, it was followed by FMCG products and then fashion. Now, e-commerce apps like Myntra, Flipkart, Meesho also have shared some stats on how their respective sales went. So, Myntra said that it saw over 1.2 million new users, the highest ever, shop from its platform, with beauty and personal care and watches and wearables driving demand. It also sold 189 t-shirts, 115 shirts and 61 tops every minute. Now, Flipkart, on the other hand, saw over 1 billion customer visits on its app, again the majority from tier 2 and 3 markets, and it also sold 3 saris and 2 kurtis every second and about 250 shoes every minute. Now, while electronics at the same time grew about 20%, over 50% of the mobiles that were sold on Flipkart were those costing over 20,000 rupees. And overall, most consumers picked EMI constructs to make purchases. Meesho, whose focus was tier 2 plus markets, saw 3.34 crore orders being placed, led by kitchen utilities, personal care, fashion, among others. Now, this also made over 20,000 of its sellers Lakpatis and over 24 crore-patis. Now, meanwhile, Amazon's Great Indian Festival sale is yet to end, so we don't have data from there yet. But Red Seer had indicated that overall $3.4 billion were clocked in all the sales across platforms in just the first 4 days. And these are on track to clock over 11 billion this festive season, as more sales are set to happen in the run-up to Diwali. Back to you.
Thank you, Shilpa, for those details. Appreciate you joining us on Startup Street. Moving on the hot seat today, we put the spotlight on farm-to-consumer brand Deep Rooted. Currently operating in Bengaluru, Hyderabad and Chennai, Deep Rooted provides urban consumers access to quality fruits and vegetables sourced directly from farmers. The venture claims through its greenhouse network, Deep Rooted can deliver a year-round supply of fresh, residue-free produce using a fraction of the water and land compared to conventional farms. To tell us how and also to talk about the road ahead at Deep Rooted, joining me now is its co-founder Avinash BR. Avinash, welcome to Startup Street. Now, Deep Rooted is a one-stop shop for fresh produce. I believe it offers over 200 varieties of fruits and vegetables. If you could take me through your asset-light business model, and most importantly, how are you ensuring transparency and trust both with farmers and consumers?
Thanks for having me. Yes, at Deep Rooted, we are building India's leading fresh produce brand. And we are trying to do this by redefining the way how fresh produce is grown, handled, and delivered to end consumers. As you rightly said, our business model is an asset-light business model. We work with farmers who have greenhouses and open field land. The current challenge that they are facing is sort of threefold, right? Not knowing which produce to grow, inability to grow the produce by getting the right yield and productivity for a multitude of challenges. And thirdly, the ability to market all of the produce that they are growing. This is the problem statement that we are solving for the farmer by actually taking the urban consumer demand, who today are discerning about the choices that they make, right, in terms of their dietary needs, what they want to eat, right? So we take this demand to this network of horticulture farms, which today is already over 1,500 acres across the 3 cities that we are operating in. And we offer agronomy service to them, right? Which means we tell them the seed to use, how to grow the crop in a contamination-free manner, ensuring yield and productivity for the farmer, and year-long, consistent, high-quality, contamination-free produce to the end consumers. So in this farm-to-consumer model, we have 2 equal stakeholders, if you will, farmers and consumers. And our value creation is to both ends of the supply chain or the spectrum, so to speak.
All right. Avinash, you also claim that through your greenhouse network, Deep Rooted can deliver a year-round supply of, fresh residue-free produce using a fraction of the water and land compared to conventional farms. Tell me, how are you doing this? Also, what is the kind of impact this has had on the livelihood of farmers, plainly speaking, monetarily?
Sure. As I said, I think that we are solving sort of 3 inefficiencies for the farmer, right? One is we are telling the farmer to grow a produce that we know we'll buy from the farmer. So that itself solves a lot of the inefficiencies, because they do not have to worry about what to grow, how to grow, and where to sell to. And coming to your point, we handhold the farmer with the agronomy service that we provide. Through a combination of technology and human intervention, our agronomists work closely with the farmer at every step in the crop production life cycle, right? In order to ensure that what is happening in the farm is as per plan. This ensures 2 things, right? So one is for the farmer, it ensures that the inputs, the money that he spends on the inputs will deliver the right quantitative output for the farmer, which we pick up. And for the consumer, what it ensures that it is a contamination-free, high-quality produce. And through a greenhouse, we are able to sort of mitigate a lot of the natural environmental conditions and pests that can affect an open field crop. And therefore, a farmer is assured of a predictable output, and consumers who buy from us are assured of the same quality throughout the year. And in terms of the quantitative impact that we've created, on an average, our farmers see 30 to 50% higher yield compared to what they were getting prior to our intervention or prior to them becoming a part of the network. Right, and the 3 levels of inefficiency together is what actually sort of plagues an average small landhold farmer today.
All right, let's now talk about your recent funding. You raised $12.5 million as your Series A funding round. The round was, of course, led by Ivy Cap Ventures along with your existing investors. You plan to expand operations in South India, of course, barring the major cities that you're currently present in, and strengthen your technology stack. If you could elaborate on these plans, and if you could also share timelines.
Yeah, so I think over the next 6 to 12 months, you'll see us increasing the network of farms that we are managing. From a demand point of view, we will continue to remain focused on Bangalore, Hyderabad, which we've been operating for over the last 1+ year, and Chennai, which, as you said, we recently launched about 3 months back. So in terms of the consumer base, we are at early days across all of these three cities, and we want to go deeper in terms of the number of consumers that we serve. However, with the increasing consumer base, what will definitely expand by 2x to 3x is the number of farms that we manage or the number of farmers that we engage with. In terms of the areas of investment, I think the technology adaptation in this sector has stopped at the farm gate, so to speak. So we will be leveraging technology across the farms that we manage, across supply chain, and also technology on the consumer side in terms of our app and website, in terms of tailoring our product in tune with the consumer's consumption pattern or buying behavior. So technology is the core investment area over the next 6 to 12 months.
Okay.
Geographically, it will be Bangalore, Hyderabad, and Chennai. And obviously, as a brand, we want to be better known than today, 12 months down the line. When it comes to fruits and vegetables as a category across these three cities that we are
all
operating
right.
in.
Okay, Avinash, consistent high quality and sustained availability are the two key factors to win consumer trust. If you could talk to me about your end-to-end supply chain model, how are you ensuring quality and availability? And also, if you could take me to the platforms where one can buy the produce, who have you partnered with?
More than 95% of the business comes from our app and website. So consumers can either log into deep-rooted.co or download the Deep Rooted app from the app stores, and they can buy the produce, consumers in each of these three cities. In terms of the end-to-end supply chain itself, I think fundamentally where we have tried to differentiate is to take ownership across the entire supply chain, right? So in terms of how the produce is grown, as I said, we manage that part with our technology and human intervention. In terms of the physical supply chain itself, we pick up the produce from the farms that we manage. We operate a centralized warehouse in each of the three cities. The challenge with perishable produce is multiple exchange of hands results in lack of freshness and the produce losing quality, right? So what we've removed is all of the traditional intermediaries, middlemen in terms of people and infrastructure. We pick up the produce from the farm, we bring it to the warehouse, we do quality check, we do packaging, and then we deliver to the end consumers. Of course, in terms of logistics, we partner with service providers, but the ultimate ownership of the supply chain is end-to-end. And that plays a huge difference in ensuring consistent quality and
timely delivery. Yes, Avinash, if you could quickly talk to us about the revenue model. What is the road to profitability looking like? What are the models that you've devised for yourself? And also, how many acres of farms are you currently managing?
So we are managing about 1,500 plus acres of farms across Bangalore, Hyderabad, and Chennai. Our business model is simple. So we are not a platform in the sense that we are not just connecting the farmer to the consumer. So we buy the produce from the farmers that we work with, and then in turn we retail it to the end consumer. So that way it's a simple model, so to speak, from a buy and sell. In terms of the profitability, that's the aspiration over the next 6 to 12 months. That in Bangalore and Hyderabad, which are our two older cities in terms of vintage, we intend to achieve operational profitability. And Chennai is a city early in the day, so it will be a city where we'll be anchoring on growth expectation.
Okay, 6 to 8 months for operational profitability. One final question before I let you go. As you expand, you plan to hire across marketing, technology, and business functions. Is this hiring going to be across all functions? And also take me through the future growth targets, both in terms of expansion and revenue.
Yeah, so I think we've grown about 4x over the last quarter or two. I think the idea is to continue to maintain that growth momentum over the next 6 to 12 months, as I talked about. And in terms of hiring, yes, I think marketing, technology, business, and operations are the key roles that we are expanding the teams in. And yes, this will be across all the cities that we are operating in. I think in terms of the farm acreage that we'll manage, I think that will grow probably much more than the revenue, given that the supply planning takes into account a lot more consideration. So from some 1,500 acres, we should be at about 4,000 to 5,000 acres over the next 6 to 12 months.
All right. And we wish you the very best for all your growth plans. Many thanks, Avinash, for joining us on Startup Street.
Thank you so much for having me.
On that note, it's time for us to head into a quick break. Coming up, we dive into Elevate's maiden fund, through which the company plans to bet on growth stage ventures. Stay tuned. Welcome back to Startup Street. SEBI announced a series of measures on Friday after a board meeting. The market regulator has issued regulations for stricter IPO disclosure. They have also introduced pre-filing of IPO documents along with some others. Yash Jain joins in with the key takeaways from SEBI's announcements. Listen in.
Well, discussions on the IPO market took fair bit of space in market regulator SEBI's agenda, and there were three important things around the primary market or the IPO market which market regulator SEBI has approved. The first one is with respect to strict IPO disclosures. Irrespective of it being a new generation technology or a traditional company, these companies will have to disclose something that is called key performance indicators or KPIs. Essentially, these are selective performance indicators for different kinds of companies which they'll have to disclose in the IPO DRHP document along with the traditional financial matrix. The second one is with respect to disclosure of price per share on the past transaction. Now, companies will have to disclose the price per share of the shares allotted to previous investors into the company in transactions which took place 18 months prior to the IPO. Now, what happens if there were no transactions in the previous 18 months? In that case, companies will have to disclose price per share of allotment given to investors in the last 5 rounds of fundraising up to about 3 years prior to launching their IPO. The third and the most important one was introduction of pre-filing or introduction of confidential filing of IPO documents. Here, any company can have an alternative mechanism of just filing some basic details with market regulator SEBI, expressing its intention to launch the IPO, and as it comes closer and the plans for an IPO firm up further, it can then disclose the other sensitive business information along with its DRHP document. What that does is that in case a company decides to not launch its IPO, then in that situation, the key sensitive business information does not go out in the public domain.
All right. Moving on to our segment Investor Eye now. Elevate Venture Partners has announced the forthcoming launch of its $200 million India-focused sector-agnostic fund. The maiden fund intends to invest in growth-stage, technology-driven companies with a ticket size of $5 to $15 million. To elaborate more on the fund, joining me now is Naveen Hunagudi, Senior Partner at Elevate. Naveen, many thanks for joining us on Startup Street. Now, let us just clear. Early-stage platform Venture Catalyst is an institutional backer of Elevate, and this is Elevate's maiden fund. So tell me, how soon do you plan to launch the fund, and what made you enter this space? What is the white space in domestic growth stage VC funds that you've identified?
Yeah, thank you for having me over, Smriti. So essentially, the idea came up about a year back, wherein where we were missing out on a lot of preemptive rights in some of our portfolio companies at seed funds. I think this market was roughly $500 million, where early stage seed funds and super angels lost out on about $500 million of preemptive rights or pro rata rights last year. And as you can imagine, pro rata right is not only a contractual right, but it is a company law right, which allows existing investors to continue investing in further fundraisers of the company and hence not diluting their stake. So what started off as an idea continued towards conceptualizing Elevate and focusing on raising a growth stage fund. So Elevate has tied up with some of India's leading seed funds and super angels to invest in pro rata rights of their winning portfolio company. This is one of India's first, while globally there have been several analogies.
Yes, Naveen, we'll delve into that a little later. But first, I wanted to know, how soon do you plan to launch this fund?
So we've received our approval from SEBI about 3 weeks back. This is a Category 2 fund. We intend to do our first close in early part of next year, around Jan to Feb timeframe.
All right. So I believe, like I mentioned earlier, Elevate will invest in Series B and C rounds in fast-growing tech companies. How many startups do you plan to invest in? And I believe the ticket size you're looking at is $5 to $15 million?
Yes. So there is fair bit of flexibility of the fund to go up to $20 million as well in a single check. But you're right, the average ticket size would be about 10 to 15 million. Elevate would look to invest in anywhere between 12 to 14 companies in the life cycle of the fund.
Okay, now let me go back to something that you were just talking. Another part of Elevate's strategy is to focus on partnering with India's leading seed funds, which have missed out on investing over $500 million of pro-rata capital in 2021 alone for their successful portfolio companies. Now, while similar structures exist in the US and Europe, if you could elaborate on this pro-rata fund that provides basically unparalleled access to oversubscribed rounds alongside top-tier investors, if you could elaborate on what this is all about.
Yeah, absolutely. And in India, as Indian market, financial market and the venture capital market is getting deeper, it allows us to enable a lot of differentiated derivative plays coming out from the same venture capital framework, right? Which is where the idea of Elevate came up. So we have partnered with some of India's leading seed funds and super angels to invest in winning companies of their portfolio company. This will be largely at a Series B and Series C. Now, that is a stage where most of the seed funds relinquish their preemptive rights and hence continue to get diluted. The idea is that we would partner with some of these seed funds. The incentivization for them is a carry share into Elevate Fund. So we work more as partners into Elevate rather than this being a fairly commercial sort of an agreement. Besides this, you were just talking about the other white space that I see in the Indian growth stage. This also comes from, being India's sort of first data-driven fund to a certain extent. Now, today, if you look at it, the valuation range of between 100 to 350 million that Elevate is looking to play, there are broadly about 500 to 600 companies in that stage. What Elevate is doing is, having a very strong sort of a 10, 12-point checklist, which gives investors a strong understanding of the kind of companies that we would want to invest in. While it is a blind pool fund, but this sort of data metrics enables investors to do their diligence beforehand before committing to the fund, which is what some of our anchor investors and larger institutional investors have provided.
Okay, so I understand that Elevate has built a proprietary data-driven algorithm, in its investment framework, which basically, provides LPs with strong visibility into Elevate's capital deployment strategy. But can you elaborate on the technology? How does it do this?
Yeah, so essentially there are several both primary and secondary databases available, right? And there are several platforms where the data of these 500 to 600 companies are available. There isn't just anybody who's leveraging on this data. Some of this data could be both primary as well as secondary research. We are in the early stages of building out that framework, but see a clear visibility towards our deployment thesis in this model.
Some of Elevate's previous investments include Paytm, Shiprocket, Vedantu, BharatPay, BlueSmart, and many others. How do you go about picking winning ideas? What is Elevate's investment thesis?
So these have been some of the investments by the partners of Elevate in the past. As you rightly pointed out, this will be Elevate's maiden fund. I think clearly what we look to invest as some of the thesis is large market opportunities of companies that you see on your slide, companies which have opportunity to create billion-dollar outcomes, not only by valuation, but also revenues in time to come, and essentially backed by a fairly strong founder with differentiated business model. I think these are broadly the three aspects that we look at a very high level while investing in any company.
Okay. All right, Naveen, one final question. You claim to drive founders in the right direction, irrespective of market conditions. What are the current market conditions telling you, and what conversations are you having with your founders now?
I think the conversations that most VCs are having with the founders is fairly similar, which is driving towards profitability sooner rather than later. I think the current market conditions have driven the rationality in the market as well as the founders in the right direction. Those are some of the conversations. And, 21, we've seen a full cycle of the venture capital ecosystem that all have been focusing on for the last 15 years, right? Investments to exits in the form of IPOs. I think we'll continue to see more of them in times to come.
All right. On that note, we'll have to wrap up our conversation. Naveen, many thanks for joining us on the show today, and wish you the very best with your maiden fund.
Thank you very much, Priti. Thank you for having me on.
All right. With that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.